Alright, cool. I think we should be recording. But yeah, just full disclosure, I've kind of tried recording this like 3-4 times now and kind of getting fed up. So I'm going to make this a really quick video. But yeah, today's video is just on Carvana. As always, for anyone who doesn't know Carvana, a quick company description here is they essentially operate an e-commerce platform for the buying and selling of used cars in the United States. And when I say United States, I literally mean just United States. This morning I actually tried to go on the website for, like, as always, I like to look at the product or service when I research a company. And yeah, given this massive blocked sign or message, so which is great. So I actually can't even look at the website. But yeah, they completely and only operate in the United States. Obviously, as always, a quick breakdown on the price, shares and stuff like that. So the price as of Friday, which was the 2nd of May, 2025 obviously, was $257 per share, which gave a market cap of around 55 billion, and then obviously accounting for cash and debt gave an enterprise value of around 60 billion, which if you go on to the sector analysis, you'll see is by far the largest publicly traded used car sales company pretty much in the world. As always, I'm not going to go too much into depth on everything in this analysis or in this document. If you want to read everything yourself and kind of go into more detail, as always, recommend going into the description below and grabbing the document down below for yourself, and then you can kind of go into things at your own pace and look at everything else. So quick comment on the business model then. So I've kind of broken it down into three sales streams, which is retail, wholesale and other. And also a quick comment on the company itself actually, which I didn't mention, is that Carvana are quite unique in the used car sales space, where they kind of have a merge of the two kind of typical business models in the space. And what I mean by that is, so Auto Trader, for instance, are, I would say, a quite a modern new company and within the used car space. However, they are more akin to, say, an eBay, where they don't actually buy or sell cars themselves, but rather they provide a platform for individuals to go onto to then list their cars, and then other individuals buy the cars directly from them. Whereas obviously a more traditional used car sales company like AutoNation or Penske, they'll buy obviously your used car from you, they'll do it up, and then they'll sell it for at least, or try to at least anyway, sell it for a profit. Whereas an auto trader can't take a commission from each sale that happens on their platform. So Carvana are quite unique in that sense, where they kind of operate a very modern online platform, obviously via their website, which I can't look at, thank you very much. But yeah, so they kind of have this website, but they still then have a traditional business model in the sense that they'll buy the car directly from you. They'll then usually do it up and then sell it again directly to the consumer. And essentially that business then is what the retail vehicle sales segment is, which accounts for roughly 70-80% of their total revenue, depending on the year you look at. But again, as I've kind of talked about here, they can either have your car delivered right to your doorstep, or you can kind of pick it up at one of their iconic vending machine pickup locations. So the wholesale vehicle segment is quite small, so it's only around 15% of total revenue. And essentially all it is more just older mileage cars, or cars I guess they believe is less desirable that most likely won't really sell. They'll just sell it wholesale, just get rid of the stock and the fleet, and they'll sell it to either other wholesalers or just kind of list it at massive auction sites, which also kind of accounts for their recent acquisition in 2022 of Adisa. I think it's how you say it, Adisa, where basically this company is just a physical auction house business, and they kind of use that around nationwide 56 auction sites to essentially offload these vehicles that are probably less desirable. And then the most interesting, in my opinion, segment is the other products and services. So this primarily consists of vehicle financing to customers, and essentially the sale of auto insurance and extended warranties and that kind of high profit margin services. And the reason it's actually for me the most interesting is kind of this point here, where I'll talk about the loans are later sold to third-party investors or securitized. So essentially what they'll do is they'll kind of give customers financing, but then they'll kind of securitize this financing and then sell it off to other insurance companies or other finance institutions who then buy that debt off Carvana. The reason I find it's quite interesting is because it's very similar, for anyone who's watched like The Big Short or who's very familiar with the global financial crisis with mortgage-backed securities. It's actually kind of very similar and akin to that, where a lot of their customers are arguably subprime customers, and they're given a lot of subprime loans through these car dealerships, through these car financing. And I think we'll kind of go on to it a bit later, but you'll see the interest rates some of these car financing is being issued at is very high. And the reason, again, is super interesting is the fact that in 2023, this segment only accounted for 7% of total sales, yet it was 100% of gross margins. Moving on to the cost structure of the business then. So as always with most companies, you'll have it broken down by cost of goods sold, which then impacts gross profit margins, and then selling, general and admin expenses, which is basically admin expenses, which will impact operating profit margins. Cost of goods sold then will just basically be purchasing the cars, reconditioning them, just kind of direct costs. And then the SG&A, very standard, like marketing, advertising, customer service, IT, all those kind of stuff. The financial performance of the company here is super interesting. So even though we have seen like massive increases in interest rates the last couple of years, they've somehow actually managed to turn performance around in 2024 significantly. As you can see here, the total amount of retail units, so cars sold, increased by 33%, while total revenue increased by 27%. They've not given the breakdown for gross profit per unit, which is a very key metric or very key KPI. Again, this kind of links back to the Hindenburg report, where they essentially expose this figure of this $5,500 per unit gross profit, where essentially some costs which should be in here were kind of omitted and taken to SG&A. Whereas when you look at the rest of the sector, they don't do that. So again, I won't go into it too much detail, but yeah, this figure very controversially was, just not very accurate. And so funnily enough, at the last year end, they didn't even actually disclose this number. They basically just pretended like it didn't exist, which again is a massive red flag. But again, when you look at the rest of the numbers, fantastic turnaround, especially for how bad 2023 was compared to 2022. Again, they had a good excuse, which was interest rates rising. And as we'll go on to the competitive landscape here, you'll see a lot of direct competitors actually got bankrupt. So actually, we can talk about that now. So in terms of looking at competitors, then obviously you do have CarMax, which is the primary competitor at the moment. But unlike Carvana, CarMax pretty much are traditional car sales company, where they more focus on physical locations and buying and selling within local regions. Whereas Vroom and Shift Technologies were two direct competitors, where they both were both e-commerce used car sales only, and then they both actually went bankrupt due to obviously the tough market conditions around 2023, 2022, due to obviously increasing interest rates and then a massive plummet in demand for used cars. So touching on the sector then, don't really want to go too much into this, but I guess the primary points here being we've obviously been in a very high interest rate environment, which obviously has meant high financing and interest rates on car loans. So I believe I found here the average interest rate for a used car had risen to around 11.6% in the last quarter. That was, I guess, the average for all credit tiers, which was double the rates from prior years. So I'm believing like 22, it was around 5-6%, or 21 especially. So the fact it's nearly doubled has had a massive impact on the used car space, and like I've mentioned before, has meant the bankruptcy of two direct competitors in Vroom and Shift Technologies. Looking at the future outlook then for Carvana, I'd say obviously I do see sustainable growth and market share. At the moment, they only have 1% of the used car market, so they have ample room and runway to expand on this, especially with the collapse of Vroom and Shift. There's definitely opportunity to grab former customers from these platforms. Also, as we modernize and keep progressing, more and more consumers rather shop online. We're seeing less people wanting to shop in physical locations. So we'll kind of see this trend continuing, and obviously a company like Carvana will benefit from this growing trend of online purchasing and e-commerce. A good point to mention, however, is the debt and financial stability of the company. So one thing I've not talked about yet is the actual balance sheet for Carvana. As with most companies in this sector, it's not great. So they have quite a significant amount of debt and liability, which then obviously results in high interest costs. And this interest expense will have a massive drag on the net income of the company. They have managed to push back a lot of the maturity from 2027 to 2030, giving it some breathing room to essentially to keep growing and increasing their cash position, because as I kind of aforementioned, they've now turned cash flow positive in the last couple of years. So this should hopefully help them build a decent cash position now then when obviously 2027 to 2030 comes around and a lot of the debt starts maturing, they should hopefully have a decent cash position to start paying off the debt. But again, that is just something to keep in mind if you do want to go long. Obviously, if you want to go short, then it's probably not an issue. There's some really good comments here actually on the macro outlook as well, going into the future. I kind of realised the video's gone on for like really long now, so I don't really want to get too much into it, but I definitely recommend either pausing the video, reading this now, or again, getting the document yourself. But essentially, the best case scenario from a macro perspective for Carvana would actually be a mild recession. The reason for I'd say mild recession is that will essentially force lower interest rates, because then if you get lower interest rates, then people will then have easier access to financing and debt, which they can obviously then use to buy cars. The reason you don't want a severe recession, obviously, is then kind of like the global financial crisis in 2008 with what we'd call the credit crunch, is people then struggle to even get any debt or financing, so they can't really buy something as significant as a car that will obviously cost tens of thousands of dollars. And obviously we'll see significant job losses in a severe recession. Whereas in a mild recession, you will obviously see job losses, but not to such an extent. And the reason I'd say a mild recession is arguably or paradoxically the best case scenario in 2025 and 2026 is because the way the current economy is set up, if we don't really enter a recession, we'll probably see high inflation, and that would be an absolute killer for the business, because a high inflation scenario will then mean less rate cuts that are currently anticipated. And with less rate cuts, what that essentially then means is that cost of financing is going to be very high. And so again, what we saw in 2023, 2022, and so what we saw in 2022, 2023, where a lot of, subprime customers struggled to get financing, we'll kind of see that continue and exacerbate going into 25, 26 with a long sustained period of high interest rates, right? Because the longer, a high interest rate environment sticks around for, the probability simply that you'll get more delinquencies and people essentially defaulting on their loans will increase. So that is definitely something to keep an eye on, is hopefully we do see some significant rate cuts coming into these next few months and quarters. So as always, I won't really talk about the qualitative points. You can kind of either pause the video or grab a document yourself. But some really good analysis here on strengths and weaknesses of the business, some pro tips as I always give, and some Wall Street insights, which again, always of interest. All right, then, to conclude, we then have the fair value price target for 2025. As always, with businesses and companies, I always value them based on their sales and earnings, as these are obviously the two key metrics for any business, top line and bottom line. And then obviously within these two key valuations, I then break it down between market and what I believe is a reasonable valuation multiple to assign. And for the breakdown of the analysis for the reasonable valuation multiples, I always obviously give it down on the side here. So you obviously factor in stuff like the current outlook of the sector and Carvana itself. So talking about here, you can see I believe at the moment the used car market is stable but cautious going into 2025. There's some significant capacity for growth. As aforementioned, they have about 1% of the used car market in the US, so loads of headroom to grow. And the macro environment at the moment isn't too bad. Obviously, there are tariffs, but again, used car prices, in my opinion, are stabilizing, although interest rates are definitely the biggest macroeconomic factor impacting the business going into 25 and 2026. And then there's also some things to be cautious about, specifically the aggressive selling of car loans. Again, in the Hindenburg report, they talk about how they essentially just accept anyone and have 100% application success rate when someone does when someone applies for car financing, which is definitely an issue. And they also, again, in the Hindenburg report, have some questionable accounting and some insider-related deals with like related parties and things like that. So we also need to factor that in. We also look at peer comparisons, so see what CarMax have, and then also it's not always easy with a company like Carvana, who are quite, unique and innovative with their business model. We also then look at things like typical e-commerce retail averages as well, rather than just also the used car sales market, to kind of give an inkling, an idea. break it down as always into bullish and base case scenarios. Personally, once I factor all this in, I've kind of leaned towards more the base case things, more the base case valuations. So I believe appropriate PE ratio to give the companies a 30x multiple, which you might think is quite aggressive, but I mean, if you look at, I guess, the 2024 is 127 and 2023 is 70. This is primarily because, again, the company has been focusing on top line revenue, so that's why their EPS has been kind of dampened. But going into the future, they've now obviously turned it around, so they are forecasting quite high EPS. And so I do think you can now value the company on a PE. And again, given the growth and things like that, I think a 30 multiple is quite reasonable to assign. And then based on the price of sales, I've given it a 1.5. The reason for this is kind of the midway point, again, between all the scenarios. And it's on the upper end for what you'd give a typical average e-commerce site. But then I guess what's quite incredible then is when you exclude the market. And again, the market multiples are just basically prior year. So whatever the market has given the company prior year is what I essentially assess as the market value in that company. So the market essentially values Carvana at 3.2 sales multiple and 120 PE ratio based on prior year stock price and results. But if you exclude that, then you get a reasonable fair value price target of only $108 per share, which, as I mentioned at the beginning of the video, they're currently trading at $257 per share. So there's massive downside risk, which also, I think if you take into the fact the Hindenburg report with also the massive risk and headwinds given potential fraud, there's some serious red flags with this company. I definitely would not recommend going long. In terms of going short, maybe you can again look at the technical analysis here. If you look at the support and resistance, there is, to be fair, near the resistance line now around $270. So from that perspective, it might be a good time to enter a short position, maybe a small one. But I definitely would not recommend going long this company, given the potential fraud aspect of the business, and then the valuation, in my opinion, is just kind of insane. It's kind of getting valued at it's kind of being valued like a tech company, when in reality it's essentially all it really is an e-commerce site. But yeah, I think I'll leave the video there. Again, kind of went on way too much longer than I expected. As always, if you have any questions, just drop them in the chat. But yeah, I'll leave the video there.